Swayam Prabha. Digital India. Educated India.
We have seen the performance ratios, liquidity ratios, profitability ratios, etc. There's a last set of ratios. We call it, what do you call it, as the efficiency related ratios. Why do you say efficiency? We are talking about the efficiency in utilization of, what do you call it, as various resources out there, and that is what we call it as the turnover ratios out there. We are talking about, for example, as you can see on the screen, I am talking about the efficiency of utilization of the assets out there, the efficiency of utilization of the fixed assets out there, and so on out here listed. So, they are what we call it as typically measurement of efficiency of utilization, and that is what we call it, typically what you call it as turnover ratios. Now, let us take some examples out here. I will say, I want to know how efficiently are my fixed assets utilized out there. I would say, how efficiency is my, what do you call it as, fixed assets being utilized. So, I want to see the fixed asset turnover ratio. The fixed asset, when I say, we call it, when we say fixed asset turnover ratio, what I mean is, how many times is the sales value of my fixed assets? That is that fixed asset being utilized time and again, time and again, time and again? Or for example, if I say my fixed asset is, let us say, 10 lakhs, my sales is only about 3 lakhs out there. That shows what happens, you have too much of fixed asset, that is the fixed asset value is about 10 lakhs, your sales is only about 3 lakhs. So, when are you going to even recover the cost that you invested, money that you invested in fixed assets? The money that you can recover for the investment in fixed assets is only, what do you call it, as the profit or margin there, not the entire sales value, because sales minus expenditure, or what do we call it as return. So, whereas when I say my fixed asset is 10 lakhs, my sales is 100 lakhs in the process, that is my sales is equal to 10 times my fixed assets out. Then naturally there is going to be a margin, and that margin is leading to the recovery of the fixed assets out there, the cost of the fixed assets, or I would say return on my investments out there. So, what do we see? We are talking about efficiency. So, we say, what do you call it as, fixed asset turnover ratio. So, what do we do in this? We normally say net sales by what we call it as average fixed assets. Here, let me qualify, when I say average fixed assets, I use the word net, average net fixed assets. Now, why did I write that in red color, average net fixed assets out there? Now, let us sort of decipher this. When I say net sales, in this particular case, net sales means, what do you call it as, my gross sales minus my discounts given minus my sales returns. That is what we call it as the net sales. That is the core sales, because I want to know, because I can say take gross sales and calculate, but imagine you are giving a 10% discount for most of the sales what happen, then what happens? That is not a proper, appropriate, correct figure out there. So, I want to say net sales. When I say average net fixed assets, please note I am going to use a different color out here. What do you mean by average net fixed assets out here? Average net fixed assets. We have, when we discussed the balance sheet, we said what is called as gross block and we said net block. What is the difference between gross block and gross block? Gross block, original value of the asset. Here, current value of the asset. That means my gross block minus depreciation is what is called as my net block. So, when here I would say net fixed asset, taking the gross block is meaningless because I would have bought the asset 20 years back out there. Now, taking the value which was 20 years back today and comparing its sales is of meaningless. I want to look at the value as of today. We say average. Why do you say average out there? Because normally what happens when we worked on what do you call it as the, when we worked on what is called as the return on equity or return on capital out there, what did I say? We take this equity part or the capital part or the capital part as what do you call it as the opening. Because why we take opening? Because closing capital will include the profit for the current year. Let me take an example. I said I start with a capital of 100. That is, this is I started, that is what we call it as opening capital. During the year I make a profit, I retain it, retained earnings is $10. What is the end of the year capital? That is capital at the end of the year, 110. When I calculate what is the ROI or RO return on investment out there, ROI or return on investment out there, I will have to say $10 is the return I have got. What is the capital? Capital is not 110. This $10 you have obtained on this 100 investment that you made. So, $10 is the investment that you have made on the investment of 100. What do you call it as? I am sorry to express it as basically percentages out there. You can basically do that, then I would say 10% out there. So, the closing capital makes no sense, you have to look at the opening. So, similarly, in this particular case, we say we could have ideally taken opening fixed assets, perfectly all right. But we take average. Why? Because during the year, you might go on buying some asset. Sometimes in the middle of the year I might buy an asset. For example, my financial year is from April to March, and in the month of September I buy some assets out there. In the month of December I buy some assets out there. In the month of January I buy some assets out there. In the month of June I would have bought some assets out there. At the same time I would have sold some of the old assets out there during the course of the year out there. So, what happens on the new asset that I have bought in January also, there is a return that is basically being earned out there. On the asset that I have bought in December also, there is a return that is being made out there. On the asset that I have sold in the month of June, what happens? My return on that asset stops in the month of June out there. So, we take yearly average fixed assets out there. What is the best way to take simple average out there? Normally, mathematically, when we basically used to calculate, we say average is nothing but opening fixed assets plus closing fixed assets divided by 2 out there is what we will take as average out. Is what we will take as average. That is just the average part of it and average fixed asset. So, this tells me how efficient, how many times fixed asset turnover ratio tells me how many times how many times of the fixed asset is my sales value. That gives me an idea how efficiently my fixed assets are being utilized in the organization. Now, sir, can I do a current asset turnover ratio? Yes, you can do. you can do, we are not, that is what I said, ratios will have to be devised. For example, if your organization is very low on fixed assets, it is a service industry, and you have a huge current assets out there, then what happens? Current asset turnover ratio makes more sense in that particular case out there. So, as of now, we are not looking at that. Next, what happens in this particular case? I will sort of say, let me go to the next thing out here. Let me say that I mean, we looked at the current assets. I want to look at my total asset. Let me make that as total assets out there. Let me write it, spell it out. Total assets turnover ratio. Because I want to see, because I know that fixed assets constitute a substantial portion, but there are other assets also that are being invested out there. There are other assets also on which I am investing money out there. I want to know whether overall my asset utilization, because my fixed asset could be very small, my other assets could be very large in that particular case. So, I want to know overall is basically, is it giving, what do you call it, as the efficiency part of it. So, simple, same thing, the net sales by average net total assets. The net word you have to, I will color it differently out there, the net word out there, I will color it very differently in that particular case. When I say average, this, why do you say, sir, why average net total assets out there? Now, well, let it again, as I said, when we talked about fixed assets, yes, we talked about fixed assets out there. Now, even when you talk about total assets, for example, I will have a large amount of debtors. 10% of the debtors are doubtful. So, what happens? My net debtors, when net total assets, when I take debtors minus the fellows who are not going to pay, minus the doubtful debts, I will take, that is the net of debts out there. So, I will want to know the real position of the assets. So, I am trying to see the efficiency of the utilization of all the assets out there. Sir, in what context should I use fixed asset turnover ratio? In what context should I use total asset turnover ratio? Typical manufacturing, heavy amount of investment among the total assets out there, a fixed assets constitute a substantial portion of your fixed assets out there, I mean of the total assets out there. Then what happens? Fixed asset turnover ratio will be more meaningful in that case. Fixed asset is very small. Most of the assets are floating assets what I have out there. Most of my assets are floating. I am a trader. Most of my assets are floating assets. I am a service industry. Most of my assets are floating assets. I would prefer to go in for total asset turnover ratio out there to measure the efficiency part of it out there. To measure the efficiency, I can even go further. I can even go one step further and I will say invested capital turnover ratio. Whether the utilization of capital is basically the sales, same thing out there, the sales revenue out there, or let me use the same terminology in all these places out there. I am going to use the same terminology. I would say net sales by total invested capital. Sir, what is the total invested capital? Let me explain what is the total invested capital out there. Invested capital in this particular case is, what do you call it, as the long term debt plus equity, which is inclusive of reserves and surplus. The total equity, what we call it as. So, what is happening? Is the capital being utilized efficiently? Is my sales sufficiently large to compare to the capital that I have basically invested? Now, can I say equity turnover ratio? Yes, you can do it. I can even what you call it as dissect it, and I say my net sales by total equity. I can say my equity turnover ratio. So, is the equity capital in my company, the long term debt is a very small portion, or long term debt is directly tied to a particular equipment or whatever it is. My equity is a large portion. I want to see whether my sales is X times my equity out, whether my equity is being utilized efficiently or not is what I would want to see. So, all this what? This gives me whether the capital is being used efficiently, whether the equity is being used efficiently. Because because what happens in these particular cases in an industry like this, the efficiency is measured based on the revenues what they have, and the revenues will be decided based on the amount of capital that is basically invested in the business out there. The revenue is based on the capital that is invested. Same thing out there in this particular case. In the first case I took both long term and then equity. In the second case I said I want to look at only equity. ETO is equity turnover ratio. Let me again, okay, let me write this more legibly in the process out there. Now, equity turnover ratio. So, what is happening out here? So, I am looking at the efficiency of the equity utilization, I am looking at the efficiency of the capital utilization out there. Now, can I go a step further in this? Yes, you can go a step further in this. I can say why invested capital? Can I look at working capital turnover ratio? Can I look at working capital? Because working capital is the money that I am utilizing for the day to day operations of the organization. Is my working capital being utilized efficiently? Yes, I can say that my net sales divided my average working capital. Average working capital out there. Now, you know how to calculate working capital. Working capital is nothing but what do you call it as the current assets minus the current liabilities out there is going to give you the net working capital requirement. When I say that is the money that I am going to borrow, why that is the money I am going to borrow? Let us see, part of the current assets is financed by my current liabilities. If I say gross working capital, then only the current assets is the gross working capital out there. That is current assets, we will say normally minus cash. Now, what is this, sir? Gross working capital, net working capital, not very clear. Let me explain that. What happens? What is current assets? My current assets is my inventory. My inventory can be raw material inventory, can be work in process inventory, can be finished goods inventory. Next, my debtors. I have purchased material. That means what? I have paid money and bought, or I would have bought on credit. Debtors, I have sold goods, I have not received money. So, what is happening? I am investing money in these places out there. That is what is the, for example, you are buying only on cash, you are not buying anything on credit. So, what is happening? The entire inventory you have invested your money. On the debtors, your money is blocked, it has not come back. That is, you have invested money on material, material is converted to finished goods is sold, there is a cost involved, and that entire money has to come. So, this is the money that you require for operations. So, that is why we call it as gross working capital. Now, what is the net working capital? Now, I will say, I have my current liabilities also here. I buy on credit. When I buy on credit my raw material, when I buy my raw material on credit, that means I am given, what do you call it as, that fellow will give me 30 days credit. So, whatever raw material that is there here, I have not paid for it, whatever raw material that is there here, I have not paid for it, I am that somebody has given me that credit out there. So, I do not need money for the raw material that is here because I have bought on credit from somewhere. So, part of my current assets is financed by my current liabilities. So, what is my net working capital? Net working capital is all the current assets minus the financing that happens because of the current liabilities is what we call it as the net working capital requirement out there. So, in this particular case, now let us look at the working capital turnover ratio. In the working capital turnover ratio, what are we looking at? We are looking at the average, because your working capital varies through the year, average working capital. How many times is that sale compared to your average working capital? That means, is your money sticky? That means, if your money is not moving, if for example, my sales is only once or less than 1 of my working capital, that means what? A lot of your money is blocked. Your money is not rotating. Your money is not rotating. Money is blocked in inventory. Money is blocked in debtors. It is not moving. And what is happening? The debtors are stuck. The inventory is stuck. Whereas your sales is some 100 times your working capital. That means there is a fast churn. There is a rotation that is continuously. There is what is called as collection that is happening continuously. There is a payment that is happening to your creditors. So, working capital is getting churned out more often. Efficiency. If working capital is getting churned out more often, then your organization is supposed to be lightly efficient, more efficient out there. So, that is what we see with the working capital turnover ratio, and we saw invested capital turnover ratio here in the previous case. I am looking at the capital, I am looking at the working capital. There are a few more, we go on. So, we saw working capital. Now, working capital, can I dissect this working capital? Yes, possible. I can do what is called as inventory. I can do inventory turnover ratio. Now, I can do inventory turnover ratio in general, or I can do raw material inventory turnover ratio, or I can do what is called as finished goods inventory turnover ratio, whatever it is. I am keeping it general out there in this particular case out here. What is my inventory turnover ratio? My COGS, cost of goods sold, divided by my average inventory. That is, how many times is the cost of goods that you have sold equal to your inventory out there? How many times? What is the value? How many multiples of inventory is your cost of goods sold? Now, this average inventory as such does not give me a great picture out there. Rather, I should look at specifics. I will say my COGS divided by my average raw material inventory. That means I know what is the value of the cost of goods sold compared to the raw material inventory that I have. That means how efficiently, how fast my inventory is getting churned out of the organization. That is, how many times I am buying continuously, how many times it is going out. So, what is happening? The churn, what you see, that is what we see out here when we look at this. Because this obviously will not be measured with sale, obviously purely because it will be measured with what we call it as cost of goods sold. Because cost of goods sold is what is happening. Cost of goods sold means consumption of inventory happens. When consumption of inventory happens, how much of inventory are you consuming? How fast are you consuming the inventory? What is the value of the inventory that is consumed vis-a-vis the inventory that you have in your godown? Now, you might ask me, sir, in the previous case, when we sort of worked on what do you call it as the working capital part of it, you took sales. Yes, I am looking at sales out here because I am not looking at the COGS, because this is the money that I am investing in the place. Because, so I will compare it with the sales, working capital requirement we calculated here, the money that I am investing, so I will compare it with the sale out there. Whereas in this particular case, raw material also I am investing. Now my take, what I am trying to do out here is, I am not looking at the return on the investment out there. I am looking at how quickly is the raw material getting utilized, how many times the raw material is getting multiplied in the process out there. That is what I see when I sort of do this. Whereas when I look at the finished goods inventory turnover ratio, debatable. In this particular case, I could use in a case sales out there to my average finished goods inventory, because I want to know how much of finished goods, how much sales is equal to what is the kind of finished goods inventory I will keep. So when I do the finished goods, I could possibly look at sales, whereas when I am looking at raw material, I am looking at what do you call it as the COGS in the process out there, cost of goods sold. I can also do in addition what do you call it as cash turnover ratio. What is the cash turnover ratio? That is net sales by average cash balance. Sir, why do I need to know? That is, for example, imagine this is useless if you are for industries where the purchase or sales do not take place in cash, right? This ratio is useless there. Wherever the cash dealings are very, very high in, what do you call it, for example, in a business which has what is called as the cash inflow and the cash outflow is quite high out there, I will look at cash turnover ratio. That means how many times the average cash balance I have is my net sales in the process. How many times out there is my average cash sales is the sales is average cash balance. I am looking at pure cash. I can sort of move a step further and then I can say what do you call it as, I can include cash and cash equivalents out here. Then what against net sales by average balance of cash and cash equivalents. Sorry, I am going to write it more legibly. Cash and, in this particular case, I could include what is called as the money that is there in the bank, not the liquid cash alone, like what I said here. Here I talked only about liquid cash or hard cash. I am trying to write a little more legibly. Here in this particular case, when I said cash and cash equivalents out here, in this particular case out here, I specifically mean cash balances, bank balances, marketable securities, everything what is called as combined out here in this particular case. So this ratio would be much more beneficial. That is, I am looking at the churn of cash, I am looking at the movement of cash, I am looking at how fast the cash is getting replenished every time it is sort of getting out of the business out there. So this is what we see, what do you call it as cash and cash equivalents out there, turnover ratios. How efficiently, the efficiency of utilization of cash, the efficiency of the movement of cash compared to my sales out there, because the revenue has to come from sales. So what happens? My average cash that basically I have is how many times sales out there, is about 10 times, 20 times, 100 times, 400 times, 400 times, whatever it is out there. So now that all measures efficiency. Sir, is there any specific number that you would assign to each of these ratios? No, I am not looking at numbers. As I had indicated earlier, all these ratios will depend on the context in which you are looking at the analysis. For example, let us look at the turnover ratio or the fixed asset turnover ratio right here. Imagine I look at a refinery in the initial years of its operation. or automobile assembly plant, in the initial years of the operation, all the assets, fixed assets value will be very, very high, undepreciated assets out there. If you actually do this, the number will be very, very different as compared to a service industry which is very low on assets. If you look at a service industry which is very low on assets and then compare it, it will be very, very different out there. An asset intensive industry is very different, this ratio will be very different, will have to be looked at very differently, and asset light industry, this ratio will have to be looked at very differently. So, you cannot have one single yardstick across out there. So, what happens? This analysis, the number will depend on the context in which you are evaluating all these things. So, I am not going to give you a number in all this. You have to even look at the relevance of this. As I talked to you, when I talked to you about fixed assets and total assets out there, in some context, doing a total asset turnover ratio will be useless. I would rather stick to only fixed asset turnover ratio. For example, I talked about a refinery or whatever it is. My asset intensive, I would say my total asset, my fixed asset turnover ratio is going to give me a complete picture. My total asset is not even relevant in this particular case. So, I will not even look at the total asset turnover, total asset turnover ratio. So, all these will be what you call it as context specific. Now, we talked about working capital, I talked about working capital out here, I talked about the inventory turnover ratio, I talked about the cost cash ratio out there. I can talk about two more ratios in this case in the context of working capital. I can say accounts receivable turnover ratio or accounts payable turnover ratio. Please note, when I say accounts payable here, it means and includes debtors, it means and includes bills receivable. In this particular case, it means and includes creditors, it means and includes bills payable. Now, what happens when we look at what do you call it as accounts receivable? I am looking at credit sales, net credit sales. Let me use a different color out here, so it is easier. Net credit sales. Net credit sales by what is called as my average receivables. Now, what does this tell me? This tells me the efficiency of receivables. Is my receivable very sticky? Is my receivable, for example, my credit sale this year is 100, my receivables is 1000 out there. So, that means what? My net credit sales by receivable is just 0.1 in the process. That means what? I am inefficient in collecting the receivables. I have been having a legacy problem of receivables, that is, it is accumulating, that is why it is 1000. Though my credit sale this year is only 100, my receivables is 1000 because legacy I have been accumulating it, I am not even collecting the whole thing out. My credit sale is 1000, my receivable is 100, that means it shows that though $1,000 is on credit sale, my receivable still pending, average receivable that I maintain, during the year is only 100. That means that shows my collection efficiency in the process out there. It shows my collection efficiency, that is what I would say, it shows my collection efficiency. Similarly, when we look at in this particular case, the net in this particular case of payable, net credit purchases. Net credit purchases out there divided by my average payables. So, again what is it? Similar to the earlier case, this gives you my efficiency in honoring my payments. Efficiency in honoring the payments that I have to make. Efficiency in making the payments that I make. In making the payments out there. Now, why do I say net credit sales, net credit purchases? For most of the industries out there, all sales will be credit, all purchases will be credit. So, in that cases, you need not have to take net credit sales, you can just take sales out here. You can same thing, you can just take purchases out there. So, what we are looking at? We are looking at efficiency in collection, efficiency in payables. For example, my payables are very sticky, whereas my credit purchases are very small, my payables is huge, I am not paying. That means what? In future I am going to encounter a problem, nobody is going to sell goods to me, or if they sell goods to me, they will sell it at a higher cost. My payables is almost negligible, whereas my credit purchase is huge. That means what? You are not able to match your payment credit terms with your credit terms in the sales out there. That means you are paying too fast. That means what happens? You need more and more working capital, you need more and more borrowing to manage your day-to-day working capital out there. So, what happens? We will always sing this average payables, average receivables, we will sort of try and see if we can match these things out there. My average payables is 30 days, my average receivables is 30 days, well sort of managed out there. I get money, I pay here, so I have to find a little bit of money is what I have to find. That is the time that takes for it to be converted from raw materials to the finished goods out there. The time it reaches my what do you call it as my godown, from that day till the time it takes for me to convert it to the finished goods out there. That is what we will look at out here in this case. That cycle only I need to find time. If there is a mismatch, then what happens? You need more and more money in the process out there. If you need more and more money in the process out there, then more and more borrowing, more and more borrowing, more and more interest, less and less is the profit or less and less is the return on your investment out there. So, this measures the efficiency part of it there. Now, your question, I am going to put up all these ratios also in the document what I have attached out there, already all these documents are there. Now, the question is, sir, can one of these ratios tell me the entire story of the company? No, you have to use these stories are only indicator, these ratios are only indicators. Now, any one ratio will not tell you a picture, you have to use these ratios in combination. For example, a company where there are no fixed asset, very few fixed asset, an IT firm which only survives on rented space, fixed asset is low, then in that case calculating the fixed asset turnover ratio will be stupid. Calculating the fixed asset turnover ratio will be useless. So, what is happening? So, you will have to look at the ratios. You will have to look at the relevance of the ratios for the relevance of the with regard to the company you are trying to analyze, and all these are what do you call it as, each of these ratios in isolation will not give you any picture. These ratios will always have to be looked at what do you call it holistically in the process. Depending on the company you are analyzing, choose the ratios. These are only indicative ratios, please note. These are only indicative ratios. Choose the ratios accordingly and then look at it. For example, for a company which is unlisted and you have not even the stock, the shares are not even traded in the market, it is a closely held company, then where is the dividend yield? Dividend yield will make no sense in that case unless you are making a purchase or something. So, your ratio calculation will always be in what you call it is in conjunction with what is the company that you are trying to analyze, right. For example, so what happens for a company which has zero debt capital, there is no difference between return on equity and return on invested capital or return on capital employed. It will be the same because your capital is only equity, debt is zero. So, what happens? The ratios what you choose will always depend on the kind of company you are trying to analyze. Okay, this completes the ratio analysis. So, what happens? We have completed the financial statements, the P&L, the balance sheets, the cash flow statement, and then the ratio analysis. So, that completely finishes a large part of your financial accounting out there. So, I would say with this I have sort of completed part of it, only barring one or two more concepts which I am going to do now. We have completed the financial accounting part of it. Now, from here now we move to the cost accounting part of it. We will spend a couple of weeks in cost accounting part of it, and then the basics of finance out there. One other concept which I want to discuss out here is what we call it normally in accounting or in working capital in finance is what we call it as the operating cycle. And what do you call it as cash cycle? Let us understand what is this operating cycle out. What happens? How do you run a business? You first thing you do is you place an order for your raw material. Now, I move here, this raw material basically gets supplied and then to your godown, to your stockyard, and you buy on credit, and basically you have purchased on credit out there. You have purchased on credit, whatever the credit period. Let us not worry about it. Now, what happens? It gets issued for production. Whatever is the time lag between these. Once it gets issued for production out there, then by in between what happens? The payment has to happen to the supplier out there. That is, the payment has to happen to the supplier. That is, payment happens to the supplier out there of raw material. Then what happens? You make a sale of the finished goods on credit. Then what happens? Towards the end out there, you do collection of cash on sale out there. Now, what is an operating cycle? The operating cycle, when I talk about an operating cycle out here, this entire phase is what we call it as the operating cycle out here, or at least we would say from the minute the good is supplied till the time I collect, this entire thing is what we call it as the operating cycle. Normally, it is inclusive of this also, but some textbooks will start from once you receive the raw material, but in reality it is from the minute you have placed the order, because from the minute you have placed the order you become obligated to pay. So, from the minute you place the order, the operating cycle starts. Normally, some textbooks will say from the minute you have received the goods, but normally this entire process is what we call it as the operating cycle. Cash cycle is very different. Cash cycle is when first money goes out, this period alone is what we call it as the cash cycle. Why this period alone is what is called as the cash cycle? Because this is when the first money goes out, and this is when the money you get back on what you have got lost out there. So, this period is what we call it as the cash cycle out there. Operating cycle will normally be large, cash cycle will have to be very, very short out there. Now, can this overlap? The shorter and shorter out there, the smaller and smaller is the cash cycle out there, the working capital requirement becomes lesser and lesser. If this cash cycle is equal to your operating cycle, then you need more and more working capital. If the cash cycle is small, then the amount of working capital requirement is less. If the cash cycle is large, the amount of working capital what you need will always be higher out there. So, all organizations will look at two things. one, first reduce the operating cycle itself, because to keep the operating cycle as short as possible. So, what happens in organizations like Maruti and most of these organizations out there, what they follow? They follow JIT. I place the order, fine, but my supply and my issue for production will overlap out there. This will what is called as this will overlap. That is, it gets supplied, I do not stock it in the yard, it just directly comes to my shop floor in the process. So, and moment the goods is ready, it is immediately sent off to the supplier and they basically pay up out there. So, what happens? The sale happens and I receive the cash right then and there out there. So, what happens? My cash cycle is less, my operating cycle is less, my working capital requirement is less out. So, longer the cash cycle, larger is the money requirement. Longer is the operating cycle, obviously longer will be the cash cycle and longer will be the money, larger will be the money requirement. Keep the operating cycle low, keep the cash cycle low, always better for you, right. This you can corroborate, you can add it to the financial accounting part of it, and then we will use more and more of it when we do with the next. So, next class onwards we will start with cost accounting. This finishes my financial accounting part of it. Thank you very much.